Hello and welcome to this Business Today Market Special. I'm Udayan Mukherjee. With me is Abha Bakaya, and our guest for today is an old-timer from the market, Devina Mehra of First Global, who's been running money in the global markets for many decades now. But more recently, she started a PMS in India, which has been one of the most successful over the last year or so. Devina, it's a pleasure having you on the show, and I cannot but ask you about the news of the day, which is the big merger in the HDFC group. What do you make of it, and what do you think it means for HDFC and HDFC Bank stocks?
See, the short term, we've seen what the market thinks of it, which is that you've seen this rally. But in any kind of merger, that's always the first reaction. Usually, it's positive. It is only over a period of time that the real picture emerges. So let us see how this plays out, because HDFC Bank, as also the banking sector as a whole, there have been this sort of many things kept in abeyance for some time. So all of that runs out in September 2022. Though, of course, I don't expect any negative surprises from HDFC Bank, but it will mean probably that the way the bank has been run as being very, very separate from the parent. I mean, now you will see a different set of managers, I assume. So let us see how it pans out. It's, of course, something I have watched for a long time since the inception of HDFC Bank itself. So from 95, I think, was the IPO, and 96, we had said that this baby will become Arnold Schwarzenegger, which it did. So let us see how this new phase works out.
Yeah. You were indeed one of the early backers of the HDFC Bank stock, Devina. I remember that. But, over the last year or two, the bank stock has lost its way. It's been one of the biggest underperformers, which is very uncharacteristic of HDFC Bank. In fact, in your own PMSs, you've had a marked preference for names like ICICI and State Bank of India over HDFC Bank. So my question is whether this deal does anything to change that view that you've had of HDFC Bank over the last year or so.
Hasn't yet. I mean, we are still studying it in detail, because that's why I rarely like to react to the news of the day, because it takes time to look at all the implications and digest all the implications. And as I said, in this case, there could be some amount of change in the management also, because still Mr. Aditya Puri was around. It was very, very separate. So let's see how this works out. As I said, I would not like to give a very off the cuff kind of response. As of now, you are right. We have preferred other banks over HDFC Bank, because it did lose some of its luster in the preceding few years. I mean, also primarily because it was highly valued to start with, and you had a lot of positive things built into the price. So from that, it's not even that on an absolute scale it had to do badly. It was just on a relative basis, relative to its valuation, that whether you would continue to see positive things. And there were also, of course, a number of regulatory things where they ran into issues on from the credit card onward. So there were many things which were kind of weighing on the stock. So as I said, I would like to just digest the news a bit and look at all possible implications before giving a response.
Sure.
Devina, markets
Well, for the day, it's lifted the market a lot.
Yes, of course.
Sorry.
Bank,
Go ahead, Abha.
Nifty and Nifty both, yeah.
I was
As I said, I mean, most mergers, if you see the initial reaction is positive. It is, but also, I mean, if statistically, I'm not saying in this particular case, statistically worldwide, over a period of time, the impact is negative rather than positive on the average. I mean, so the day's reaction is often not a very good gauge of how it will eventually be perceived or eventually work out in fundamental terms.
I was going to allude to the same momentum in the markets. We've been seeing a steady trajectory. They seem to be ready to now move past some of the bad news that they were reacting to just a few weeks ago. What do you feel the sentiment is now leaning towards, Devina, moving forward into the year?
So, I mean, not just now, but even a few weeks ago, just after the Russia-Ukraine war had started, I had written about it and spoken about it, that we actually did this analysis going back 40 years, and 40 years simply because the Sensex has been around 40 years, and looked at every point of conflict, any kind of the two Gulf Wars, 9/11, or US bombing Libya, all these kind of incidents of either big terrorist attacks or some geopolitical problem. And the takeaway was this, that there is an immediate reaction in stock markets around the world, but it is not visible a year later. So other than markets which are directly impacted, there is no visible impact on other stock markets, whether it's India, US, etc. So this I was quite clear on, at least, it may not be a statistically significant sample in terms of number of incidents, but still for whatever it is worth, and it was not on averages, it was every single instance. The only places where it was visible a year later was in the price of crude and gold.
Right.
Now, this time, the difference is that besides the stock markets being directly impacted in the region around Russia, it is also that these two countries were so important for so many commodities. Really, that is where you will see that impact play out. And it is not just energy, which is crude and gas, but also if you look at even before this conflict started, the whole range of commodities, from potash, which is used for fertilizers, to nickel, palladium, whole lot of things which were up 20 to 30% even before the war started, and also the agri commodities. So whether it is wheat, whether it's edible oils. So that is really where the impact will be, which is why if you are looking at whether you're looking globally or you're looking at India, you have to look at this impact. So if you look at globally, for instance, I mean, I was just looking at all the markets which have done well year to date, and there's a clear pattern to it, which is that whether it's emerging markets or developed markets, these are all the resource-rich countries. So if you look at globally, it is in the developed world, it is countries like Canada and Norway and Australia, which are big players in either energy or metals. Emerging markets, it's like South Africa or a lot of the South American markets, which is Brazil, Chile, Peru, which again, either energy or copper, gold, things like that. So that pattern is very visible. If you want to look at India again, this year the market is not going to be the tide lifting all boats kind of market you had in 2021, broadly speaking. So you have to look at sector by sector, and often even in a more detailed fashion, because for many not countries, the sectors and the companies, also the output prices have gone up, and for some others, the input prices have gone up. So you have to make that distinction, that if you're, let's say, in metals or aluminum kind of player, then the dollar price has gone up, and probably the rupee also has depreciated a bit. So you will be benefited. Whereas, and also some of the basic chemicals, for instance, companies are making money hand over fist. Whereas if you're in downstream chemicals, your prices have gone up. On a broader basis, this is, of course, as I said, company by company. On the broader basis, I see some, possibility of demand destruction in India, simply because the prices of food and several other staples are going up. And the Indian consumer, unlike, let us say, the US consumer, didn't start off at a very comfortable place. So once you have the prices of basics going up, you will see pressure on anything which can be classified as discretionary spend. So, on a broad basis, that will be the thing. And a whole lot of industries will see margin pressures, as I said, because so many commodity prices have gone up.
So, broadly speaking, Devina, would it be fair to say that maybe the whole consumption basket, whether it's fast-moving consumer goods, the highly expensive ones, or even the discretionary ones, which are high PE stocks, do you think chances of underperformance there because of margin pressures is high this time?
They've already been underperforming. In fact, this whole myth, which I spoke about nearly 2 years ago when FMCG was the hot sector, and I said that people think that these are all weather stocks, but that's not what the data says. I mean, people actually don't look at data. The fact is that there have always been in history long periods when they have underperformed. And this time, if you see 2021, which was a bull market, the FMCG index underperformed significantly. and it's underperformed again in the down market of 2022. So it has not outperformed either in an up market or a down market. So there are these myths that get formed around sectors. And this, of course, I mean, talking specifically, if you look at the third quarter results of the FMCG players, the margins showed a compression. Towards the end of the quarter, which is December, they started to raise prices, which showed up in demand going down. And since then, also, they have raised prices, I mean, mainly because they don't have an option, everything from the petrochems to the palm oil, everything has gone up. So you are saying downscaling, people are buying smaller units. So you will see that volume and margin hit because there is no way that they can't, that they can hold back anymore on price increases. So, I mean, always look at data and be agile, which is why we say that, don't be a bull, don't be a bear, be a hare, because things change and a hare changes direction. So that is the important thing. So one of the other themes, this year that you can look at is related to the rupee. I mean, I have been saying not since the war, but from November, December last year, that the big risk, macro risk in 2022 in India is on the rupee. So that's the other thing which you can keep in mind, that to look at the companies which are either exporters of products or services or import substitute, or where the output is a price taker from a dollar price. So those are the other things you can look at.
Right. Your point about geopolitical events not impacting the market over a long period is taken, Devina. But having said that, that is not the only risk for the market this year, is it? Because even before the war, inflation, interest rates, and the way the global setup was, it was looking slightly sticky for the market. Do you think the worst is really over, or are the markets now being complacent in bidding prices up to all-time highs again, or close to?
No, you're right. I mean, as I said, the macro risk was not in the geopolitical side, which is not to say that there is no macro risk. As I said, for India, the risk likely is in the currency, because we have decided that, I think the RBI is the most sanguine central banker in the world today, saying there's no problem on inflation, there's no problem on growth. We don't need to change anything. We don't need to raise interest rates. So that's we have taken stance that we'll maintain a loose fiscal and a loose monetary policy. So that the RBI actually now is trying to do two different things. It wants liquidity in the market so that interest rates remain low, but in order to support the rupee, it takes away liquidity from the market. So the two objectives are inherently contradictory, and at some point, my bet is that the currency will give. So as I said, that's a risk. Worldwide, again, inflation for the first time in decades has become a serious concern for the Western central bankers. For emerging markets, of course, it's always been on the something to watch, but this has happened in many, many decades. So yes, the interest rates will go up and have started going up already. I mean, they were actually going up in a lot of emerging markets for a long time, which we chose to ignore because we look at only India and US, and for us, that's the world. But the emerging markets, many countries had raised interest rates, not just once, but even 3, 4, 5, 6 times. So now that's happening in the West also. You've already seen the Fed raise interest rates. German bond yields have gone over 0% after a long time. So that is happening, and that directly does have an impact on the PE of the market, and especially for so-called growth stocks. Growth stocks meaning any stock where the profits and cash flows are far away. As the interest rates go up, the discount rate at which you discount those cash flows go up, and therefore the hit is more on those stocks, which is why you saw that the hit was more on a lot of the very fancy technology stocks. So that part has not gone away. And the thing is that when interest rates go away, both equities and fixed income get hit negatively. So there are very few places to hide. I mean, right now, our bet has been that essentially commodities and related places have been the only places to hide. But then, you can't put 50% of your fund in commodities either. So it's a tricky market for sure.
Devina, from the emerging market basket then, where do you feel capital is going to flow? Does India emerge as a strong contender given its focus on digitization and reform? Or will we see money flowing more towards the commodity-rich emerging markets?
I think, Abha, I personally am not a watcher of where the money, because I don't think that's a very relevant metric, because the data doesn't support it. If you look at the long data, eh, whether FIIs, the first time FIIs brought in money, which was 93, 94 onwards, which was a fresh source of money and billions of dollars came in, was the only 9-year period in Indian stock market history where you got zero returns from 94 or 9 years. So therefore, as I said, I'm not a big watcher of where FIIs are putting in money. Overall, if you look at India's position in the world, my bet is that this year you will see India continue to outperform as you did in 2021, simply because it happened after a very long time of underperformance. So India for many, many years used to be 19, 20, 24 in the world market listings. 2021, it number 6. So it was among the outperformers. We think it will continue.
Okay.
But in terms of overall, as I said, unless things change, right now it is either these mineral-rich countries or even agri-commodity rich countries that are doing well. So in Asia, you will see that Indonesia has done well, which is again an agri-commodity producer. And manufacturing bits of the emerging markets haven't done quite as well. So that's been the pattern till now. But no, it is a fast-changing world as of now, so one has to watch.
It seems, Devina, your big bet is commodities this year. But if that is the case, and if you were to construct, say, a long-short kind of a portfolio using commodity as a theme in India, which sectors would you be long on and which sectors would you choose to be short on, purely based on the kind of commodity spikes that we're seeing?
We don't do long short, so all our products are long only. So it is just like what you choose to avoid. And so, as I said, commodities, of course, is one thing which includes metals and mining. Chemicals, you have to be careful because chemicals are of all kinds. So some are getting hit on the margins, whereas for others it's bonanza time. If you're looking at the rupee dollar, IT is one area where we have been overweight on for a long time. In fact, that was our anti-FMCG bet, that this is another sector where things are predictable and you also have a dollar hedge. So there's been a re-rating since then, but we continue to like that, even though in the first 2 months of the year that didn't do well. So that's still an overweight sector. Oil related, we'd be overweight. Telecom, textile, again selectively. But as I said, this time it is not even so much that you can say that everything in this sector looks good. You still have to drill down considerably. But those will be broadly the sectors that we are overweight. So that, and as I said, you'll have to look at things like FMCG, etc., where there would be a margin hit. And also, for example, auto two-wheelers, if you look at two-wheelers, the volumes remain at a 10-year low. I don't think, there'll be many things in the world where volumes will be at a 10-year low. And given all this, again, food inflation, you will still not see a demand revival. So, right now, in India, you have to look at that, that creamy layer has done well, maybe also partly because the stock market did so well. So in real estate also, you see this whole divide that the high-end real estate has sold well, and whereas below that, there is nothing. And similarly, in, high-end cars and SUVs do well, and two-wheelers are in such doldrums that it clearly shows that people are not moving up the income ladder.
No, I heard you mention fertilizers. That's an unusual sector for someone or a fund manager to mention. We don't often hear it. Take us through which end of fertilizers you are bullish on and what's the rationale behind that investment.
So again, many of these are commodity plays. So worldwide also that has been a theme. So if you look at worldwide also, there are, besides the main commodities that I mentioned, right from paper, fertilizers, agrochemicals, many things prices have gone up, but you still have to look at the level of integration of a particular player, that where are they in the value chain, that is it again that for some people the input prices might have gone up, whereas for others it may be that they have the source of the raw material, and then for them, therefore, the output price going up is the bonanza time. So those are the things that you have to look at. So it is pretty, as I said, drill down there also.
Fair enough. So that gives us a sense of the kind of sectors and where Devina is focusing on. Given what you've just described, Devina, what happens to financials? I mean, do you see perhaps pressure continuing? Do you think we might see the resurgence of some of those private sector names, particularly going forward this year? And we're also counting down to another quarter of earnings. So any kind of cues or triggers that you're now waiting and watching for?
Okay, so financials as a sector is something that I usually don't like. I mean, I'm always very wary because I understand the risks in that sector. It's a highly leveraged sector where a small hit really is a big hit on your capital. So, which is why if I go back, I mean, we've now been running the PMS for a little over 2 years. So for most of that time, we barely had any exposure to financials. We generally stayed clear, and it worked out well in 2020. I think the banking sector was about the only major sector in the negative. Last year also, while it was not in the negative, it did, I think, less than half what the market did. So various NSE indices were up between 21 to 28%. I think Bank Nifty was up 11%. So that has been clear. But now I'm, let's say, less bearish than I have been in the last couple of years. So we have increased our banking and finance exposure, though, I mean, still we would not be overweight, we still be slightly underweight. But certainly, I mean, in some ways, that whole NPA cycle, most of it may be behind us. I mean, at least one hopes so. And also, if you look at when interest rates start to go up, in the beginning, it is good for the banks, because what happens is that the loan book gets repriced, whereas the deposits get repriced over a period of time. In the global banks, that thing is very, very clear. So I mean, globally also banks have been looking good, but in India, of course, it gets a little complicated because of the large bond book, which actually is negatively impacted when interest rates go up. So you have to little bit again look at it more carefully. But broadly, that theme holds, that at least on the lending side, your margins go up when interest rates go up in the beginning. So for now, as I said, we have more banks than we've had in the past. We're still not overweight.
Always a pleasure, Devina, hearing your thoughts. Thank you very much for taking time out today. Thank you.
Thanks, Udayan. Thanks, Abha.
Thank you.
If you like the video, do like, comment, share and subscribe.